Hey folks, it's Vic Noble here with your weekly trade example for the week ending September the 2nd, 2011. And today I want to go kind of a little bit beyond the basics of Fibonacci levels. Fibonacci is pretty popular, everybody uses them, blah, blah, blah. And there's all sorts of information on the internet that you can get on it. The normal way to use it is to see like a major low and up to a high point. It could be up to here. And you look for the retracement levels, the 38, the 50, the 62, the 79, and beyond. And that's fine. That's fine to do that. But it's important to know that the Fibonacci levels alone are certainly not the be-all, end-all, and I certainly wouldn't advise using them just by themselves. In fact, let me tell you this. In my opinion, the best use of your time would be to spend it learning actual price action, key levels, reversal signals, and all that kind of thing. Just price alone. Today, for example, in the Coach's Corner, we looked at a very effective method of trading using nothing but price action. I mean, no fibs, no pivots, nothing but price action around a few technical indicators. Pretty cool. But using Fibonacci levels prudently can greatly enhance your profitability. So like, for example, we use them all the time in our London close trade strategy. I use them in other courses that I put out. So let me show you some ideas on how you can structure trades using key fib levels. And again, please understand, we do not use these tools, these Fibonacci levels, standalone, but rather with other key factors, right? Okay, before we make a trading decision. There are these retracement levels that we saw. I showed you from a low up to a high where the price retraces, certain Fibonacci numbers. There is also levels known as extensions, and there's also ones that retrace beyond 100%. In other words, if I go from this low up to this high, sorry, I had a little phone call interruption, but you can see we retraced these 38, 50, 62, 79, and it just kept going beyond. This is an external retracement. It retraces more than one. This would be 100% if it came all the way back to here. Well, it just kept going to 127%. See that? So this is actually a trade that we took today in the London close trade strategy. Okay. Now we didn't just take it just because it came down to 127%. Again, there's other factors. The range had qualified the way we like to see it. There was a Noble entry set up down here, and the time of day is critical because the London close has a reaction that we trade off of all the time. Shirley took this one today. She made 41 pips on this little move here. But just by using this to help, figure out where to expect there to be support. Now, if I zoom this out, I want to show you something here. Look at what happened from this low up to this high. Now, you should be watching all this. You have to learn how to watch all these things. This was 79% of the move from the low up to the high. It retraced 79%, but it was also the 127% retracement from this low up to this high. It retraced beyond 100% to 127%. That's 127%. If you took the range from the low up to the high and took 127% of that range and subtracted it from the high, that's what this does. But this figures it out automatically. You don't have to worry about that. Okay, that's a Fibonacci number. Fibonacci is an interesting topic. Like I say, go check the internet and get some info on it. It's kind of cool. Anyway, when you find these little confluences like this and overlapping Fibonacci areas, they can get your attention. You'll see on this chart here, I have most of these levels marked off that I'm watching because of price action, nothing else. Okay, that's what's important. Now, there's other ways to use Fibonacci. For example, you can get Fibonacci extensions. So if you go from a high down to a low, price rallies back and it extends. Well, look where this extended to. The 162% extension came to that same place. Remember, from this low up to this high, we're looking at that same area in here. So a lot of stuff going on down in this level here that we're looking at. See, over here, here's another example. From this high down to this low, price extended down to here. It came back 79% or so, and then kept going down and down, and went beyond this level here, this 0%, and kept going to 162%. So if you took this range here from the high to the low and took 162% of it and subtracted it from this high, you'd come down to here, which also matched up, I believe, with the 79% of this move up here. It did, right to there. Perfect. See that? So by watching these confluences makes a big difference. I'll just show you. Let's take that off of there. I'll show you another one. Recently we just had up here. We went from this high down to this low. Put that right on the high there. Look what it did. 162%. 111.90. Guess when this was? The London close. Another one of our London close trades right there. See? But again, we use this Fibonacci as a tool. I got to show you something else here. If you go way back here, look at these bigger swings from this low up to the high. I just want you to see that it actually came 109.52. It came to the same place that we were looking at today, right? This same level in here at the London close today. So there was a lot of things going on here. But again, the point of this is to know that there are other ways to use Fibonacci beside the basic, from a low to a high you get retracements, or from a high to a low you get retracements. Some people call them pullbacks, and other people call them retracements. Same thing. But when they line up with other things, like that's when it becomes important to keep an eye on. Okay, that's the key point. Like if you see, this is like a support level here along these highs in here, for example. You can see that from this low up to this high, 38% comes back to here. Okay. So I hope that gives you a little bit more clarity on Fibonacci levels. Again, I really do want to emphasize though that I know that these are really cool how they work out sometimes like that, where they match up exactly with highs and lows. But there's better ways to use them than just pure Fibonacci levels themselves. You can get into trouble doing that. I guess, as they say, if it was that easy, everybody would be doing it. So there's ways to use them. For example, like I just pointed out, that at the London close we'll use them together with key support resistance levels, together with checking how far prices moved compared to other days. We'll also use what we call the Noble entry at those levels. That really reduces our risk. So it's just one way to use them. I use them in my coach's guide course. I had them in there as well. So it's not like there's any one place to ever use them. But like I said at the beginning too, spend lots of time understanding key price levels. That's where you're going to get the best bang for your buck, and put that together with Fibonacci tools, and you really got yourself some good stuff to use. Alrighty, well, I hope that helps. It's a long weekend here in Canada and in the United States, so if you're out driving around doing something, be careful, be safe, and I'll be back at dinner next week with another weekly trade example for you. Alrighty, have a great weekend. See you then.